There is an old saying, it takes money to make money. In academic terms, this is known as liquidity constraints theory. It argues that founding a new venture is significantly more common among individuals with existing wealth, locking out talented people simply because starting a business requires significant upfront capital. Research shows that employees frequently launch their own startups immediately following a liquidity event, like an initial public offering or an acquisition at their parent company. Suddenly flush with cash from stock options, they gain the financial freedom to build their own ideas without asking a bank for permission. For founders without personal wealth, the primary barrier to outside funding is information asymmetry. The founder has a detailed picture of their technology and their work ethic, but the bank does not. Lenders view this lack of verifiable data as an unquantifiable risk, and they protect themselves by demanding high interest rates or denying the loan entirely. Without personal capital to bridge this informational blind spot, the mathematical models for new ventures suggest that many innovative ideas fail to reach inception. Venture capitalists operate in the dark, backing companies with no revenue and zero guarantees. To justify writing a check with an extreme informational disadvantage, they use a framework called real options theory. Traditional accounting tries to predict a single path to profit using net present value calculations, but this fails in the chaos of a startup. This diagram illustrates the difference. Instead of locking into one rigid timeline, investors use early capital to purchase an option to learn, represented by this expanding, branching decision tree. If the startup hits a dead end, it is not a total loss. The failure is calculated as the cost of the option to acquire market data. By mapping investments as a series of strategic options rather than all-or-nothing bets, investors can systematically navigate extreme ambiguity. Treating high-risk ventures as a sequence of purchasable options provides the economic logic that allows investors to deploy capital into unproven markets. To secure that funding, founders have to actively dismantle the investor's fear of the unknown. They do this through signaling theory. Investors cannot directly see a startup's true quality, so they look for costly, observable signals. When a founder invests their life savings into the company, they broadcast a message of confidence. Low-quality founders who secretly know their product is flawed cannot mimic this level of financial risk. But the transmission of these signals is often warped by the audience receiving them. Studies on bank lending reveal that implicit gender biases cause lenders to evaluate identical data points differently depending on whether the entrepreneur is a man or a woman, often resulting in smaller loan amounts for female founders. A brilliant product is useless if the founder cannot effectively transmit credible, costly proof of their quality through the noise and biases of the market. Because proving your worth to outsiders is so difficult and expensive, founders develop a strict defensive sequence for financing their operations, known as the pecking order theory. This maps the exact capital hierarchy founders use. They prioritize internal cash at the peak to maintain independence. Next is debt, requiring interest but protecting ownership. Equity sits at the base. Fracturing the equity tier to issue shares dilutes ownership, risking a board-led replacement. Capital structure acts as a defensive fortress, carefully calibrated to protect the founder's strategic vision from external interference. Even after securing capital and protecting the cap table, a new friction emerges internally the moment a founder delegates authority. Agency theory defines the inevitable conflict between the owners of a company, the principals, and the executives hired to run it, the agents. The primary threat is moral hazard. Owners cannot monitor executives constantly. Managers face a powerful temptation to prioritize personal utility, like pursuing perks or avoiding decisions, over the enterprise's financial health. This asymmetry reaches critical levels in public markets, where executives hold a high-definition view of the company, while retail investors operate in low resolution. When insiders reveal data selectively, such as Elon Musk tweeting about unsecured funding to take Tesla private, it triggers regulatory intervention to prevent market distortion. These internal transaction costs remain a constant threat to capital efficiency, unless governance mechanisms like vesting schedules and stock options are used to align the agent's financial interests with the owners. Assuming a company survives the gauntlet of funding and internal politics, it must answer to the classical economic benchmark for survival. John D. Rockefeller scaled Standard Oil into a monopoly using this exact principle. While legacy refiners increased production volume and drove up their own shipping expenses until they went bankrupt, Rockefeller managed his empire with precise marginal visibility. He built proprietary pipeline networks and secured rail contracts, expanding output into new regions only as long as the revenue from a new barrel of kerosene exceeded the precise cost to refine and ship it. Today, digital platforms have turned that static equation into a live tactical weapon. Amazon uses machine learning algorithms to manipulate product pricing and solve complex hub logistics puzzles millions of times a day, matching localized fulfillment costs with a consumer's willingness to pay in real time. Mastering the margin at a granular level is the mechanism that allows companies to maintain profitability within volatile commodity sectors and digital ecosystems. But strict financial optimization is not the only path to scale. Some founders purposefully reject maximum short-term margins through a practice called behavioral satisficing, securing solid financial returns while dedicating capital to other core objectives. Dame Anita Roddick famously modeled this approach while scaling The Body Shop. Instead of sourcing ingredients from the cheapest unverified suppliers and keeping packaging costs near zero, she insisted on ethical sourcing, fair trade supply relationships, and refillable containers. Traditional analysts warned that these moral constraints raised production costs. Instead, this focus on stakeholder health over short-term optimization built trust with a consumer base that was skeptical of mainstream corporate practices. Entrepreneurship operates under a strict set of financial physics, requiring discipline in how capital is raised, deployed, and tracked. Yet the strategic advantage often lies in the founder's power to redefine what value actually means to the market.